Something just shifted in the silver market and almost no one noticed it happen. There was no press conference, no emergency alert on your phone, no headline screaming panic. But beneath the surface, a quiet signal moved through the system, tied to silver, tied to JP Morgan, and tied to a subtle kind of US emergency most people don't know how to recognize. And once you understand what that signal actually means, it becomes hard to ignore what might come next. Here's the part most people miss right away. Markets don't always react to events. Sometimes they react to absences, to what doesn't happen, to what suddenly goes quiet. And right now, silver is responding not to a loud crisis, but to a muted one. A pause, a hesitation, a moment where the usual signals from the system didn't line up the way they were supposed to. And that's where things start to feel unsettling. Publicly, silver looks fine. Prices move, but nothing dramatic. Analysts talk about supply and demand like they always do. Commentators focus on interest rates, inflation chatter, and stock market noise. But here's the part no one explains. The real pressure in silver isn't showing up in price first. It's showing up in behavior, in who's moving, in who's waiting, and in who suddenly seems very careful. JP Morgan sits at the center of this story, whether people like to admit it or not. Not because of a scandal, not because of a headline-grabbing event, but because of position, scale, visibility. When an institution that large changes how it behaves around silver, it matters, even if it never says a word. And lately, the behavior has been restrained, quiet, almost deliberately boring, which raises a question most people aren't asking. Why now? This is where it gets disturbing. In moments of real stress, markets don't always explode. Sometimes they compress, participants pull inward. Risk gets managed instead of chased. Exposure gets adjusted instead of advertised. And the people closest to the system start acting like they see something the rest of the crowd doesn't. Silver has a long history of moving this way. Calm first, explanation later. Here's something that should make you pause. During periods when the US system is under strain, not always obvious strain, but administrative or operational strain, certain data flows slow down. Oversight shifts, timelines stretch. That doesn't break markets outright. It changes incentives. Suddenly, certainty becomes more valuable than yield. Control matters more than speed. And silver, more than most assets, sits right at that crossroads. You'll hear that silver is an industrial metal. You'll hear it's a hedge. You'll hear it's volatile and unreliable. All of that is true and incomplete at the same time. What silver really is a coordination problem. It exists in physical form, financial form, and strategic form all at once. When the system runs smoothly, that's manageable. When the system sends mixed signals, silver starts to reveal the tension. But here's the contradiction. If something important were happening, wouldn't price reflect it immediately? That's what we're taught to believe. Efficient markets, instant reactions. But silver doesn't always play by those rules, especially when the stress isn't emotional but structural, when it's about process, settlement, and confidence rather than fear. This is where the idea of a quiet US emergency starts to make sense. Not an emergency you see on TV, not one that shuts down markets, but one that forces institutions to think differently about timing and exposure. When systems are strained behind the scenes, the smartest players don't rush. They wait, they reduce noise, they avoid drawing attention, and that silence itself becomes a signal. JP Morgan's role here isn't about a single action, it's about consistency. About how positioning lines up with moments of uncertainty. About how exposure seems to flatten when others expect aggression. That doesn't mean something has already happened. It suggests preparation. And preparation usually means someone doesn't like the range of possible outcomes. And that's not even the worst part. The worst part is how disconnected the public narrative is from the underlying mechanics. People are debating silver based on charts and headlines, while the real story is happening in settlement preferences, delivery expectations, and risk management decisions that never make the news. Those are quiet moves, but they're rarely random. Ask yourself this. Why does silver keep becoming relevant during moments when institutions quietly reassess the system? Not during obvious crashes, not during hype cycles, during transitions, during pauses, during times when clarity is delayed. That pattern keeps repeating and most people still write it off as coincidence. This is where it gets uncomfortable. The silver market is relatively small compared to other global markets. That makes it sensitive. Small imbalances matter more. Small shifts in behavior can have outsized effects later. When a large participant adjusts even slightly, the ripple doesn't show up immediately. It builds, slowly, invisibly. And here's another unsettling detail. During periods of institutional uncertainty, paper claims and physical realities tend to drift apart. Not dramatically, just enough to matter. Most of the time, that gap closes quietly, but sometimes it doesn't. Sometimes it waits for a moment when the system tries to normalize again. That's when the tension releases. Publicly, everything looks routine. Privately, risk managers are paid to imagine scenarios that never make it into press releases. And when those scenarios start overlapping across institutions, behavior changes in subtle but consistent ways. Less leverage here, more optionality there, a preference for flexibility over returns. Those are defensive signals, whether anyone admits it or not. But here's the part no one explains clearly. Silver doesn't need panic to move, it needs resolution. It moves when uncertainty collapses into clarity, when delayed information finally surfaces, when systems that were stretched try to snap back into alignment. Quiet emergencies delay that alignment. They store pressure. Look back historically, and you'll see this pattern more often than people realize. The biggest silver moves often come when the noise dies down, not when it peaks, when everyone thinks the risk has passed, when attention shifts elsewhere. That's when the market reconciles what actually happened versus what was assumed. This is why the current moment feels different, not dramatic, not chaotic, just tense in a way that's hard to describe unless you're looking for it. JP Morgan's posture, silver's behavior, the absence of aggressive positioning, the lack of urgency in public commentary. All of it points to a system that's watching itself very carefully. And that raises an uncomfortable question. What are they waiting for? Because waiting implies expectation. It implies that something hasn't resolved yet. And when large institutions wait instead of push, it's rarely because they're confused. It's because they don't like the asymmetry. They don't like how outcomes skew. And silver, again, tends to sit right where those asymmetries become visible first. Here's another contradiction to sit with. If this were nothing, behavior would normalize quickly. If the system were fully confident, positioning would look more aggressive. Instead, what we see is restraint, quiet adjustments, a kind of collective holding pattern. And markets don't hold patterns like that without reason. This is where it gets disturbing again. Quiet emergencies don't resolve cleanly. They resolve through delayed consequences, through small mismatches finally being addressed, through price moving not because of news, but because the system has no other way to balance itself. For you, watching this from the outside, it can feel like nothing is happening, like silver is just drifting, like the JP Morgan angle is overblown, like the phrase US emergency sounds exaggerated. But the most important stresses rarely announce themselves that way. They show up as caution, as silence, as a refusal to commit too early. Now here's where all the pieces start to connect. Silver is sensitive to trust, timing, and coordination. JP Morgan is sensitive to system-wide risk and exposure. Quiet US emergencies strain processes without triggering alarms. Put those together and you get a market that looks calm but isn't settled. That's the key word, settled. Because settlement is where theory meets reality, where paper promises meet physical constraints, where timelines matter. When systems are under subtle stress, settlement becomes more important than speculation, and silver lives at that intersection. So what does this actually mean for the market? And for you watching it? It means the next meaningful move in silver is unlikely to come with a dramatic headline. It will come when the system tries to return fully to normal and discovers it can do so cleanly. When delayed adjustments finally surface. When quiet signals turn into visible outcomes. It means price may lag the underlying tension until it suddenly doesn't. It means volatility may appear without a satisfying explanation. It means calm periods can be misleading, not because they're fake, but because they're transitional. The quiet US emergency isn't about collapse, it's about strain. The JP Morgan signal isn't about blame, it's about positioning. And the silver shock isn't about a single moment, it's about reconciliation, about a system catching up to itself after pretending nothing was wrong. When all of that converges, silver doesn't explode out of nowhere. It adjusts, sometimes sharply, sometimes uncomfortably, always in a way that makes people say, that came out of nowhere, even though the signs were there all along. So when you see silver sitting quietly, when you see large institutions acting restrained, and when you hear almost nothing where you expect noise, don't assume it means stability. Sometimes it means the opposite. Sometimes it means the system is holding its breath. And now that you've seen how these quiet signals line up, how the public story diverges from the private mechanics, and how silver fits into that gap, you understand why this moment matters more than it looks like it should. Now you see what most people don't.